This is a Group 3 financial analysis of MedStar. This is for the summer HCAD 640 Financial Management for Healthcare Organizations. Dr. Benita Davis, instructor. In 1999, MedStar Health Group and Helix Health merged to create MedStar. MedStar is a not-for-profit organization with 120 entities based out of Columbia, Maryland. It's worth over $5.6 billion and currently is one of the largest employers in the region. MedStar has more than 30,000 associates and 4,700 affiliate physicians. The purpose of this presentation is to provide a detailed financial analysis of MedStar, including liquidity, profitability, operating efficiencies, capital structure, and then analysis, PESTLE, and SWOT analysis.
Liquidity ratios measure an organization's ability to meet its short-term debt obligations. There are numerous liquidity measures to consider. A few of the most used liquidity measures include current and quick ratios. The current ratio indicates an organization's ability to meet its short-term debt obligations. It shows the relationship between the total current assets and the total current liabilities. For the past 5 years, MedStar's current ratio has been above 1.0. This means MedStar can meet its short-term obligations. Looking at the quick ratio measures the ability of an organization to pay its short-term liabilities by having assets that are readily convertible into cash. A ratio higher than 1 indicates that the organization owns more than what is due. Since MedStar's quick ratio has been above 1 since 2016, this means that MedStar owns more assets compared to liabilities.
Hello, my name is Angela and I'm from Group 3. I'm discussing profitability of MedStar Health. Profitability ratios examine the company's ability to generate earnings, profits, and cash flows as compared to money invested. These include gross profit margins, which show business earnings by comparing gross profit to sales revenue. A high gross profit margin ratio means the business can efficiently handle its operations, while a low profit margin can lead to low sales and stiff competition. Operating profit margins show earnings as a percentage of sales before deducting interest, expense, and income. A high operating profit margin means business can afford to pay fixed costs and handle competitors. Net profit margins. They represent a business performance after deducting all expenses, including taxes and interest. MedStar's net patient service revenue comprises of hospital inpatient, outpatient services, physician services, and other patient service revenues, which are determined in the performance period certified under the contracts by transferring services to customers. As seen in the table summary, MedStar has net profits of $136.4 billion in 2020, enabling it to offer services at reduced costs as compared to 2019. MedStar also has net profit of $297.1 billion in 2017, thereby able to pay its fixed costs and reinvest the rest of the funds in the community as compared to 2018. Lastly, a net profit of $111.3 billion in 2015, giving MedStar a better chance to survive, but a decline in 2016, placing a strain on the business. Thank you. Next, you will hear from Victoria with MedStar's Health Operating Efficiency.
First, we're going to take a look at the inventory turnover ratio. This is a great tool for figuring out how much of the inventory is being used over a period of time. This provides valuable data that could help make the use of the inventory more efficient. After calculations were made, it was found that the inventory turnover ratio for MedStar in 2016 was 85.25, dropped to 79.95 in 2017, raised to its highest ratio in 2018 with a score of 81.12, and dropped for 2 consecutive years to 77.46 in 2019 and 72.25 in 2020. Next, we'll take a look at the accounts receivable turnover ratio. This is another great tool that is used to track the collections of payments over a period of time. This data provides medical facilities with the knowledge of how fast or slow they are receiving payments from their patients, insurers, or third-party payers, and how long it takes to collect on outstanding debt. The accounts receivable turnover ratios were 6.71 in 2016, increased to 7.2 in 2017, remained approximately the same in 2018 with a ratio of 7.27, but then dropped down slightly in 2019 with a ratio of 7.13 and a ratio of 7.17 in 2020. The last ratio evaluated was the accounts payable turnover ratio. This is used to calculate the rate the organization pays off its expenses over a given period of time. This data provides medical facilities with the knowledge of how fast or slow they are making payments towards their debt or expenses. It also shows how many times within the year organization is able to pay off their accounts payables. The accounts payable turnover ratio for 2016 came out to 8.78. It raised up to 9.27 in 2017 and continued to increase to 10.05 in 2018, to drop down slightly in 2019 with a ratio of 9.96, and then raise back up to 10.86 in 2020. That is a lot of numbers, so what exactly do those mean? These ratios reveal that within the past 5 years, MedStar has had all their inventory turnover above 72%. This indicates that MedStar has a high turnover ratio with their inventory. This means that their inventory does not stay in their facilities long, but rather is used over the process of a year. With a higher accounts receivable turnover ratio, it indicates that patient bills and debts were paid off faster, and MedStar received their money sooner rather than later. Interpreting this data shows that in 2016, when the ratio was 6.71, it took longer for bills to be paid, whereas in 2018, the ratio was 7.27. These ratios can be used to further determine the turnover in days, which helps show exactly how many days it takes to receive money from a patient or payer for the service provided. In order to make that calculation, you take 365, which is the total number of days in a year, and divide it by the accounts receivable turnover ratio. Lastly, we'll go ahead and take a look at the accounts payable turnover ratio. When this ratio is higher, it indicates that the payables are covered that many times over within the year and their bills and debts are paid off faster. So when you take a deeper look at this data, it shows that in 2016, when the ratio was 8.77, it took longer for the bills to be paid, whereas in 2020, the ratio was even higher at 10.86, representing faster payment. These ratios can be further used to determine the turnover in days, which helps show exactly how many days it takes to make a payment on the facility's bills and expenses. In order to make that calculation, you take 365, which is the total number of days in a year, and divide it by the accounts payables turnover ratio. Overall, taking a look at the past 5 years of MedStar, it can be concluded that they efficiently manage their inventory, effectively manage their accounts receivables, which optimizes their cash flow, and they have superior debt management.
The MedStar capital structures consists of a combination of debt and equity used to finance its operations. To target its capital structure with an ideal debt mix and common equity with plans to finance its investments. The equity capital arises from the claims to its future cash flows and profits, and the debt structure, issues and loans, and equity come from forms of retained earnings. Also, the short-term debt is part of the capital structure. If you look over to your right at the graph, the 2020 assets in blue is 75.7%, which is a 2% increase from 2019. The debt in orange is 5.9%, which is a 5.1% increase from 2009. And the equity in gray is 18.5%, which is a 7% increase from 2019. The MedStar capital structure analysis focuses on the following capital structure ratios. The total debt to total assets looks at the leverage position, where the more liabilities means less equity, indicating more leverage position. Some drawbacks of this ratio, it gives equal weight to operational liabilities and debt liabilities. The next ratio, debt to equity, is useful in determining the riskiness of MedStar's borrowing practices. The capitalization ratio gives a little bit more realistic insight into debt and uses the quotient of long-term debt divided by long-term debt and equity, and compares the debt component to the equity component of the capital structure. And finally, the cost of capital ratio uses the weighted average of capital to determine the cost of each part of MedStar's capital structure based on the proportion of debt and equity. These are the 4 key ratios for capital structure evaluation. The analysis compares MedStar's 2020 cost of capital to the industry average provided by the U.S. sector of hospitals, healthcare facilities. This comparison included the for-profit organizations, but for operational basis are similar for the purpose of this analysis. The table lists the ratios in the corresponding industry average, the MedStar computation, and the comparisons of the 2 values. We are going to primarily look at the 3 ratios: cost of equity, cost of debt, and cost of capital, and its comparison to the industry averages. Going to the first row, MedStar cost of equity is 11% higher than the average at 18%. But the cost of equity exceeds the cost of debt and is risk to shareholders only and does not affect MedStar's income statement and is a low risk category. Going down to the third row, looking at MedStar's cost of debt, which is 2.9% lower than the average at 1.6%. The lower ratio is associated with low risk operations, and the weighted average cost of capital can be used to estimate the expected costs for all of its financing and is considered in the low risk category. The fifth row looks at the MedStar cost of capital, 1.6%, which is 2.9% lower than the average at 4.59%. The lower ratio is associated with the lower risk cost capital and is considered a low risk category. The other key ratios is total debt to assets, and for 2020 was 0.78. It is an increase of 0.07% or $560 million from 2019, but the debt ratio did increase but is still a lower risk category. The other key ratio is a total debt to total assets ratio, and for 2020 was 0.078. It's an increase of 0.07% or $560 million from 2019. The debt to asset ratio did increase, but is still in a low risk category. In review of the 4 key ratios, the total debt to total assets, the debt to equity, capitalization ratio, and the cost of capital ratio, we're looking at the MedStar capital structure, and these ratios are all at low risk with respect to managing the short-term and long-term debt for its equity stakeholders.
Now I would like to bring your attention to the discussion of SWOT analysis, which represents the organization's strengths, weaknesses, opportunities, and threats inside and outside the business. For SWOT analysis, MedStar has been preventing its current and future threats by proactive investment such as patient safety and health information technology, because MedStar keeps threats low by investing in research to discover opportunities while increasing its profitability as external forces of the economy fluctuates. Also, the study of MedStar financial internal and external elements can support the organization to attract and retain new talent personnel, for example, nurses and doctors, while keeping pay and benefits competitive. Under PESTLE analysis, a mixed method review of MedStar's financial statements, online articles, and secondary resources were used to determine influential environmental factors derived for PESTLE analysis, including political, economic, social, technological, legal, environmental factors. These components for MedStar business effectiveness and feasibility for growth and developments. For the last 5 years, MedStar market trends suggested that the organization has a strong foundation that includes proactive financial investment, a technological advanced system, and beneficial geographies that can support MedStar to excel under unprecedented situations. With some minor irregularities in financial changes, MedStar will continue to grow as an organization and as a powerful business sector. For example, under political, the national connections help strengthening collaborative political vision, including family medicine, behavioral health, and COVID-19 response. Under economic, MedStar also constructs its foundation of long-term economic strategies by heavily invest in the MedStar Health Economics and Aging Research, also known as HERE. Under social, MedStar serves one of the most culturally diverse populations in the U.S. within the greater Washington, D.C. and Baltimore areas. Under technological, it is at the forefront of the industry for using health information technology. MedStar is supporting population management and value care based to deliver care to maximize the benefits. Under legal, MedStar prioritizes patients' best interest while preserving patients' autonomy, dignity, civil rights, and involvement in the care. Under environmental, the leading model, MedStar Montgomery Medical Center, is the pioneer of the practice green health. MedStar has efficient and proactive frameworks dedicated to health care, sustainability, and environmental achievements. Conclusion. Based on MedStar financial analysis from 2015 to 2020, the report suggests the following statements. MedStar has been able and is projected to continue to meet its financial obligation with current ratio above 1.2, pay short-term liabilities with quick ratio above 1.2, produce highest gross profit margin ratio current shows in recent years, pay off fixed cost and reinvest in the funds in the community, have good standing of productive inventory turnover ratio with less inventory stays in the facilities, increase receivables turnover ratio leading to patient bills and debts to be paid off efficiently, maintain high payables turnover ratio leading organization bills and debts to be paid off faster, maintain capital structure at low risk, manage short-term and long-term debt for equity stakeholders, stabilized business at low-risk debt, increase internal supporting factors by continuous investment, including patient safety, health information technology, while continuing to grow. Also decrease external risky factors with prevention programs, business and community development, resource deployment, expansion, strong compliance, safety-first commitment. Lastly, the final conclusion. MedStar financial findings from the report suggest that the enterprise is operating and growing within acceptable operating parameters of a large healthcare system in a good standard. Here are the references. Again, Group 3 would like to thank you for the opportunity for us to present our findings. and we appreciate your attention. Thank you very much.